Okay, let's jump in. Have you ever had that feeling watching the market like, wait, I've seen this movie before?
Absolutely.
You know, the crazy bubbles, the sudden crashes. History seems full of these
And
clues.
it really does.
So today, we're doing a deep dive into exactly that. Why market history repeats itself. We'll be pulling some really powerful ideas from giants like John Bogle and Benjamin Graham.
Two titans of investing.
Exactly. And our goal here is to sort of pull out the key lessons from what they learned to help you prepare better for whatever the market throws at us next.
Well, what's really striking is how some things just don't seem to change much over time. Bogle puts it nicely. He says, the fundamental things apply as time goes by.
Right.
He talks about these relentless rules of humble arithmetic. Basically, investment returns, especially for specific funds, they tend to pull back.
Pull back how?
They revert to the mean of the market or below. It's almost like, gravity for investments.
Ah, okay. So what goes way up?
Exactly. It often comes back down, or at least levels out. He says, yesterday's high-performing funds often become tomorrow's laggards.
So chasing last year's winner isn't the best strategy.
History suggests it's often a losing game. It's this powerful force borne out by history, and Bogle warns that smart investors ignore it at their own risk.
Okay, that mean reversion idea makes sense, but why? Why does that happen? What's pulling it back?
Well, a huge part of it seems to be us, human emotion.
Our own psychology.
Yeah. The sources explain that these swings in the emotions of investors momentarily derail the steady, long-range upward trend in the economics of investing.
So we get on our own way.
Pretty much. It's fascinating when hope is high, PEs are moderate, but then when fear's in the saddle, like during a panic,
PEs plummet.
they get very low. He didn't mince words. He observed that the speculative public is incorrigible,
Incorrigible, meaning
stubbornly resistant to learning from the past, basically. They just keep making the same mistakes. He saw people buying anything at any price, just because there was buzz or action.
like FOMO, fear of missing out.
Precisely. He points back to the 1920s, that whole new era investment idea where people actually argued a stock's quality was, like, separate from its price tag.
Which sounds crazy now.
It does. But history shows, again and again, these bright, energetic people promising miracles with other people's money. It's been happening since time immemorial.
And how does that usually end?
Graham says they inevitably brought losses to their public in the end. Our emotions set the stage for that reversion to the mean.
Wow. Okay, so if we step back and look at the bigger picture.
History teaches a clear lesson. Long-term returns really depend on the fundamentals represented by earnings and dividends.
The actual business performance?
Right, the stuff that's generally reliable and sustainable. Speculation, on the other hand, with those wide swings in the market's valuation.
That's the emotional part again.
Yeah, and it's episodic and spasmodic. It comes and goes and bursts. It's not a steady path.
So putting this all together, what's the practical advice for someone listening? What can you actually do?
Focus on what you can control. That's a huge theme.
Okay, like what?
Well, number one, cost matters. This is pure Bogle. He stresses how even tiny, small differences in compound interest lead to increasing and finally staggering differences in capital accumulation over the long haul.
So things like high fund fees, taxes,
Yeah.
they really eat away at your returns.
Massively.
Mm.
He calls it the tyranny of compounding when costs work against you. It significantly cuts into your net return, what you actually keep.
And often quietly, right? You might not even notice it year to year.
Exactly. It's insidious. So the key question becomes, how do you fight back against those costs and let compounding work for you?
And the answer is
The sources really point towards the triumph of indexing.
index funds.
Yep. An index fund just aims to replicate a market index, like the S&P 500. It buys and holds those securities.
So it's not trying to pick winners or time the market.
No active management trying to beat the market, which means costs are typically very low.
Hmm.
Plus, you get broad diversification automatically, and it tends to be highly tax efficient.
And lots of big names recommend this approach.
Oh, yeah. Peter Lynch, Charles Schwab, even Benjamin Graham himself, the father of value investing, eventually advocated indexing for most everyday investors.
That's quite an endorsement. So the big takeaway seems pretty clear then. Markets are going to fluctuate. That's a given. But if you understand these historical patterns, that pull of mean reversion, how much our own emotions drive things, and the huge impact of costs.
You can navigate it all with a lot more confidence. You have a strategy that isn't just based on hope or fear.
It empowers you to make smarter, calmer decisions.
Absolutely. So maybe here's a final thought to leave you with.
Hmm.
If history does indeed rhyme,
Yeah.
what current hot new product, or maybe some factor everyone thinks is totally unpredictable right now, what might be quietly setting itself up for the next big reversion to the mean in today's market? Makes you think, doesn't it?